Good morning, Anna.
Good morning, James.
There's plenty outside in your trust too, I hope. Do you want to tell us a bit about it, please?
Yeah, and hopefully I can convince some people that APO is one of those fantastic opportunities, right now. But good morning, all. I'm Alan Gauld, a senior investment director in the Aberdn private equity team, and I am the lead portfolio manager of Aberdn Private Equity Opportunities Trust, or APO for short. If we move to the next slide, just to open. So APO was launched over 2 decades ago. It's in the FTSE 250, and it's over $1 billion in net assets. And essentially what it does is providing investors with exposure to what we believe are some of the best private equity funds in the market, and also direct investments into private companies alongside these high quality managers, which these direct investments are called co-investments. It's mainly focused on Europe and has been for over 20 years. And it's mainly focused on mid-market buyout. So buyout being when a private equity manager takes majority control of a business, and these businesses tend to be cash generative, profitable businesses in sort of niche market leaders and in businesses of the future. It mainly invests APO through funds, both on the primary market, so making a commitment to a fund day one, or the secondary market, where you buy a fund position from another investor part of the way through its life. But it also makes now direct investments into private companies, co-investments alongside leading private equity managers. Other things to note, this has a flat management fee and no performance fee. The fee's 95 bips on NAV. It pays a quarterly dividend as well, which currently equates to a yield of 3.7%. And lastly, long-term performance has been strong. It's grown every year since 2010, and the annualized NAV total return since inception is 11.3%. If we move on, just briefly on the manager, stable management team, no senior departures since 2019, average industry experience of 22 years in private equity amongst the team. So that's very quickly on the team. I've only got 15 minutes, so we'll rattle through some of that. Onto strategy. So maybe just talking about some of the points of difference. So firstly, on access, this is the reason why this trust exists. It's to provide investors of all sizes, types, with access to what we believe is some of the best at private equity. It's a very complex asset class in many ways. There's over 3,000 private equity firms in Europe. There's over 15,000 globally. And what I would always say to someone thinking of investing in private equity is that you have to access the best. Top quartile and second quartile managers in private equity, those performers outperform public equity quite materially. However, the sort of bottom quartile, third quartile private equity funds, the returns there are undifferentiated from public equity. So from that point of view, to access the high performance that private equity can provide is about accessing the best. And those managers are often oversubscribed. Often from private equity funds are typically in a limited partnership structure, and you need to have a minimum check size of 5 to 20 million in order to access those funds. And liquidity is obviously a key thing here. You can trade in and out of positions in the private equity market, I would say within a 3-month period, but obviously daily liquidity is not generally available. So these trusts are really helpful in that regard. So moving on to some of the points of difference here. In many ways, I like this chart, but when you get to the right-hand side, I like it less. The trust has grown its NAV pretty much every year since its inception, apart from between 2008 and 2010. So it's consistent NAV growth. And so far, year to date, we're, even with an FX headwind, the trust is growing 3% in terms of its NAV total return. So you can see that light blue line illustrating the NAV. The sort of darker blue is the share price total return. And as you can see, as you move along from the year 2001 onwards, NAV and share price used to track each other very closely. Then around global financial crisis, there was a disconnect there. And in private equity, it's not just APO, but private equity trusts in general, there's been a sort of discount over the last 10 years, despite the performance. And you can see that discount widening in 2010 with COVID. But right now, the discount is above 40%. So to Andrew's point around some of those potential bargains, we believe that APO is one of those. We kind of scratch our head at this discount because we have real confidence in the valuation of the book. And then so far this year, we'll come to it, our distributions have been at an average uplift of 23% when compared to the valuation prior to exit. So see good signs in terms of the valuation, and slightly confused why there's a discount on this trust at all. But if we move on, what APO is a focused strategy. So it's providing diversification, but in a focused way. We back managers that we have high conviction in. So 55% of our portfolio NAV is alongside our 12 core European managers. This is not a private equity index. It's very focused. It's very focused on buyout, as I mentioned at the outset. It has no exposure to venture capital, typically, unprofitable businesses, and less than 5% exposure to growth equity. So, very much focused in on buyout, and very much focused in on partnering with what we believe are managers, the best of the best managers in private equity. If we move on, just to hammer home this point, on the right-hand side, you can see that illustrating that point around the core managers. But our picks in terms of fund investments, over 70% of them since inception and over the last 10 years have been in those managers that are top or second quartile. So we're really proud about that. And that is, again, kind of linked to the fact that we are not an index, and we're backing a very select few managers in the private equity market. On the next slide, just some of the sort of logos here of investments we've made. The top half of the slide are the logos of managers that we backed on a fund basis. What I would say about this briefly is we're backing more and more sector specialists. So you'll know HG with their own trust, but then there's many others there that are focused on tech specialists, likes of Great Hill, the likes of Permira, Growth, Vitruvian, and others. In terms of healthcare, we've backed Archimed, who are healthcare specialists. But again, Windrose in the United States is a healthcare specialist, as is XLR Partners. Triton is an industrial specialist. So that's the way we're going in terms of our partnerships. It's about sector specialism, knowing the market in a very deep way, but a very narrow way as well, kind of in terms of what you're focusing on. So that differentiates the manager when they're winning deals at the start. It differentiates them when they're creating value, and it differentiates them because they're more relevant to trade players upon exit as well. So we think that sector specialism and value creation provides a real point of difference. And then at the bottom, we've been increasing our exposure to co-investments. There's some logos there you'll recognize. The likes of Tropicana, for example. Some of you may have used Sport Pursuit in the past, but I'm sure there's many logos there that you don't. And these are sort of niche market leaders and businesses of the future that are growing very strongly. Co-investments are now around 21% of our book. We want to grow that even further and become more direct and reap the benefits for shareholders of the increased returns from co-investments. If we move over the slide, this is a European-focused strategy, as I mentioned. United Kingdom and the Nordic region are the largest exposures we have in Europe. You see generally our exposures to Northwestern Europe. More stable economies, more stable private equity markets. actually, somewhat ironically, for a European-focused strategy, North America is our largest single region at 22%. But most of that is European managers taking their sector specialism over to the United States. That's why that's reasonably large. If we move over the slide, again, just illustrating where we're focused on. We have no exposure to venture capital, very little exposure to growth, very much focused on the mid-market. And we think the mid-market brings the best of both worlds. It is competitive, but we don't feel it's as competitive as the larger end of the private equity market. There's still a lot of value that can be created in businesses between 100 million and a billion enterprise value. And it gives you a lot of optionality upon exit as well. Mid-market private equity firms can sell their businesses to the large mega cap players, the KKRs and Blackstones of this world. They can also sell to trade players. They can also IPO. So there's a lot more exit optionality and value creation opportunity as well. On the next slide, this is just to illustrate the point that it's pretty hard to understand what's going on inside a firm, particularly a private equity firm. We back managers we've known for a long time. So from a risk point of view, we've been able to track them, see, do they keep their promises? Do they deliver? And the vast majority of our core relationships we've known for over a decade. Next slide. Important point of this offering is the diversification. So we've got over 650 underlying private companies. You saw this sort of breakdown by geography a couple of slides ago. By sector, technology and healthcare are the largest exposures at 20% and 19% respectively. And then importantly, in terms of maturity, this diversification means that you get a pretty balanced exposure across time periods, consistent deployment. It's a cliche, and I've said it a lot of times, but people tend to come into the private equity market at the wrong time, i.e. at the top of the market, and then they come out of the private equity market at the wrong time, at the bottom, when a lot of the stronger deals can be made. We try and not market time. We're trying to do something consistent over a long period of time, and that maturity is important because it should deliver regular cash back to the trust, with just under 50% of our book having been held for 4 years or more. Private equity tends to hold assets for 4 to 5 years, so just under half of the book should be approaching a point of exit. On to the next slide. This is an important point to bring up that I've kind of alluded to already, but we're taking this trust more direct. And the main advantage of that is it strips out a layer of fees. That's been a common complaint of fund-to-fund strategies. But co-investments, as they're called in private equity, typically do not have fees or performance fee carried interest attached. So the return potential is much higher. If you build that big portfolio of co-investments, get that diversification, if you partner with high quality managers in high quality businesses, then you should generate stronger returns than a fund portfolio. And that's what we aim to do. Our co-investment portfolio at the moment has around 25 co-investments, equating to around 21% of NAV. And we're aiming to grow that even more over time. If we move on to the next slide, just an update on performance so far this year. So as I mentioned earlier, sort of NAV total return in the first 9 months of the year has been 3%. In terms of constant currency portfolio growth, it's actually the portfolio has grown 8.2%, but it's been strong FX headwinds as sterling has appreciated against a dollar and euro. And obviously some of that has come off post-June, so we might see actually that turn to a tailwind. Share price total return has been pretty good, but to Andrew's point earlier, it's off a low base. We saw a decline in 2022 post the Ukraine war, so a recovery of sorts. Net assets just shy of 1.2 billion, an expense ratio pretty stable at that sort of 1%, 1.1%, because we have that flat management fee. Next slide, please. And this is just reiterating the point I made earlier. It's consistent, strong annual growth over a number of years. Next slide. Cash flow activity has been pretty resilient despite the fact the private equity market has slowed down post the Ukraine war. But our drawdowns are outpacing distributions. But that's the reason why we have a large revolving credit facility of 300 million. And we've got around 210 million of liquid resources available to the trust. We have seen some notable exits. Most of these during the year have been to trade buyers, and they have been at an average uplift of 23%, an average valuation uplift of 23% when compared to the last valuation 2 quarters prior. On the next slide, important thing to bring out our top performers, our top 50 portfolio companies of the 650 portfolio company portfolio. Those top 50 equate to 41% of the portfolio and have been growing very strongly indeed. So you can see that in the metrics here. Revenue growth above 20%, earnings growth of almost 30%. So we're seeing really strong performance in our largest portfolio, or largest part of our portfolio. Next slide. And here's some of the larger positions in the portfolio. So first one here is Action, which I think a lot of people will be familiar with. It's in 3i. We invested alongside 3i back in, I think it's around 2011 originally in Action, and did a co-investment in 2019, and that has performed incredibly well. We've actually taken some money off the table in terms of Action and taken a partial realization there during a liquidity window that was arranged by 3i, but it's still the largest position in our book at around 4%. And then some of these others, you can see the fact that co-investment is increasing in terms of the largest positions in the book. But just to quickly run through this, I'm conscious of time and leaving time for questions. But ACT is a climate business services business, so it really helps corporates, mid-sized corporates and large corporates with climate reporting, with carbon credit trading. So a lot of the services that businesses want to undertake or take advantage of for regulatory reasons, for example, an aviation business, for example, or businesses that are looking to voluntarily show their carbon neutrality, for example. So that business helps there, and that's growing very strongly, as you would expect, given the marketplace. The third largest business there is Access, which is a ERP cloud-based business. It's co-investment. It's a fund investment through HG. So again, a number of people are familiar with that. That continues to grow very strongly, both organically and inorganically. And as a cloud-based software, mission-critical software business, it has very low churn and very high recurring revenue and cash flow. NAMSA is a contract research organization for medical devices. It basically helps the testing of new medical devices for manufacturers in that space. Again, that's ahead of plan and one that might be an exit candidate over the next 12 months. European Camping Group is a co-investment alongside PEI, and basically it does what it says on the tin. It's a campsite operator across France, Spain, Croatia, and Italy. And recently, we committed more capital to this to finance a large acquisition of one of its peers, Vacances Select. So it's growing inorganically as well. I'm just conscious of time and sort of not running through line by line, but the bottom line here is the top end of the book is performing very strongly across a range of different sectors and alongside very high quality private equity managers. On to the next slide. I mean, this is the co-investment book, as we mentioned. Again, won't go through line by line, but I would just note that it's a young portfolio. It's been held probably on average just over 2 years, but it's grown over 13% in the last 6 months in constant currency. So it's a performing book. There's not really any problem child in it to date. I'm sure one might emerge at some point, but but yeah, performing very well and driving NAV growth. So we just move on a couple of slides, and I'll wrap this up and sort of lead to questions. So balance sheet's in a good position, as mentioned earlier. We've got a larger debt facility. We upsized it the back end of 2022, and we've got sufficient capacity and liquid resources there to manage our outstanding commitments. Our over-commitment ratio is at the lower end of our long-term target range. And then just to summarize on the last slide here, so it is about providing access, APO, access to investors of all types and sizes. It is a focused, high conviction strategy, partnering with what we believe are some of the best private equity players in the market. Expertise, it's focused on Europe, it's focused on buyout and consistency, that sort of consistent NAV growth over a long period of time, that 11.3% annualized NAV total return since inception. And it's becoming more direct through co-investments. So I'll maybe wrap it there, James, and just an open to questions.